Well, today we are going to talk about investing in SIPs or doing SIPs during a sharp market fall. We all know that SIPs continue to see good inflows every month, or even the last year we've seen a steady rise. But considering the volatility in the market, what should your approach be here? Should you see a step-up SIP? Should you change the way you make SIPs in different categories? And a lot more on the show today. So let's welcome our guest for the day. Joining me today is Feroze Aziz, Deputy CEO at Anand Rathi Wealth. Gentlemen, thank you so much for joining us today. And you know, at a time like this, when investors must be wondering, what do I do with my investments? I am glad we could do this discussion. So Feroze, let me start with you first up. The basic question, what should an investor do with their SIPs now that we have seen such a big market fall?
I think the question of what to do with their SIP itself is a little, the question itself is incorrect if it came to an investor's mind. SIPs are supposed to be consistently done for long periods of time. You may still want to ask that as a viewer. Should I change the scheme of my SIP? But SIPs have to be eternal. Like your employer doesn't ask you, oh, you've become so rich, do I actually need to pay you salary the next month? Similarly, since investments, savings and your incomes, all of them are monthly, so SIPs should be consistently done on a monthly basis, practically eternally, till your income stops. And I don't think this market fall should perturb you at all. And I think falls are actually good because the future cash flows are going to be buying units for cheaper. So that's concept of rupee cost averaging. So volatility actually is a friend of an SIP. Don't be too bothered. Over the last 3 years, which is 12 quarters, market has fallen 10%. Nifty has fallen 10% 12 times. So market finds a reason to fall 10%, practically an average once a quarter. So don't be trying to seeing why is the market fallen, what should I do? Those are questions which will actually distract you from your strategy.
But that's the question we get the most, right? When markets fall, what should I do with my investments? You know, let's get some calculations on the way. What would a 10,000 monthly SIP do if it started today after 10 years? What would it look like in an investor's portfolio?
So if you look at the returns from equity are a little fluid, right? But in the long run, getting 13 to 15% return from a good, well-managed active fund is not an unfair expectation at all. So if it's 12% return expectation, 10,000 rupees per month, which is 120 months in 10 years, you would have put 12 lakh rupees in a staggered fashion. At 12%, it would become 23 lakhs. At 14%, it would become 26 lakhs. Because you're investing in a staggered fashion over 10 years, you've not invested all your 12 lakh at once. So 23 lakhs is what it will turn itself into in 10 years, and 26 lakhs if it is 14% and 12%. The former case is 12%.
That just shows what happens when you consistently invest, right, and not take a step back from SIPs. Feroze, you agree? Step-up SIP is something that everyone should do, and is there a minimum amount they should increase every year?
I think they should increase it to the extent of an increase in their pay for sure. Because if your salaries are growing by 10%, how can your investments not grow by 10%? I think that's the bare minimum. But you should, when your salaries go up by 10%, your expenses don't go up by that much. So if there is more headroom, at least 10% per annum, I think at least to the extent of inflation or your salary increase should be your step up on a consistent basis, and on a 30-year period, this step up actually compounds to almost 3 times the capital which you would have without doing the step up. So I think the whole step up concept works brilliantly for a young investor who has 30 years of investing periods. With 1,000 rupees without a step up, if you get to 50 lakhs, with a step up of 20-25%, you can get to almost 1.25 crore, 1.25 crore.
Okay, those are big numbers. So that's about mutual fund step-up SIP. Let's talk about your take on stock SIPs in this case. Do you think a new investor should start that way?
See, I think most investors, I did an analysis on 100 large stock investors. Brokers don't give the trading or an investor the alpha over Nifty. Like mutual funds publish alpha over a benchmark, a direct equity client or an investor does not have a benchmark at all. So he does 30 years of investing. I met somebody who had 500 crores. He said all fund managers don't beat beat Nifty. Then I asked him, how much do you beat Nifty by? He had not computed it. So point one is direct equity out of 100 large portfolios analyzed, 93% of them underperformed even Nifty and they didn't know about it. So that's point one. Point two, if you're sure that you are good with stocks, Should you invest in stocks in an SIP fashion? That's for sure. But first thing to validate for an investor or a trader, is he numerically good or it's perception that he is good? If you can get that, and then if higher the volatility, systematic investing becomes that much more powerful. So if you're good at stocks, then the second question is SIP good for you in stocks? Definitely more so, because it's more volatility resulting in more rupee cost averaging.
So it is your experience with stocks or your strength with stock investing that works here. But you know, gentlemen, the buzzword, as you said earlier, Nirav, was the stress test that happened. And there's so much that we are seeing in the small and the mid-cap space as well. So Feroze, let me come to you, and Nirav, you come in on that. Do you think there's a reason to worry with some of these AMCs stopping lump sum investments in small and mid-cap funds? Do you think that will have an impact on how these investors are investing in this particular category?
No, I don't think so. There's so much to worry. It's not like completely to be ignored as well. Okay, we've been tracking liquidity in small caps extensively. This month is going to be one of the first few months where small cap is going to be having a negative cash flow. First time ever. Our estimates for the first 17-18 days is minus 500-600 crores, which is not too much, but it's been consistently positive. But there's nothing much to worry, point one. Point two, I think stress test actually gives two more pieces of information for an investor to take a more conscious call. How many days does it take to liquidate a portfolio? And second is, what is the exact market cap mix of each of the funds? This extra piece of information should help an investor make prudent decisions. But having said which, I personally think there are a lot of stocks in this financial year which have tripled. And mutual funds have had a large contribution to their price rise, especially the ones with the lower free float. We analyzed 34 stocks in this year which tripled. 28 of that stocks had a huge increase in the stock holdings of the mutual funds in terms of 1st April holding to 31st December. So I think there is certain degree of higher valuations in stocks which SEBI was worried about. But I personally think you don't have anything to worry about, because India has 740 lakh crore of household savings. And mutual fund is only 25 lakh crore, and small cap is only 2.5 lakh crore. Right? So if there is going to be financialization, which we should all prepare for, there's not going to be a dearth of influx of money. So I think a negative cash flow in mutual fund is going to be a rarity in the next 3, 4, 5 months.
You know, standalone, that number looks so big, but when you put it into perspective with the larger savings that Indian households do, it seems like a smaller number there. So Feroze, tell us, I know goals differ, but what would an ideal portfolio mix look like for an aggressive, medium and low risk taker?
So I think one is what should it look like and what does it currently look like? India has just 6% of its total savings in equity. We may on shows recommend 50, 60, 80%. But the reality is Indian households have not invested so far, but they are increasing. If you're aggressive, I think aggressive, I would not call it a negative connotation of aggression. Equity held for more than 5-7 years does not underperform debt in most 95% of the cases. So 80% in equity, 20% in debt is what would be my financial asset portfolio for an aggressive investor. If you're a little more conservative, a 60 or 70 and 30 or 60-40, I think on the low risk, as long as you got 5 years, you will be able to beat about double-digit returns with both of these combinations. If you have 80% in equity, you might get to 12 to 13%. But if you have 60% in equity, getting to double-digit, I think, is a mandate in a high inflationary economy, because our inflations are as much as 5% from a CPI perspective. But most of us in metro cities experience an inflation of 8-9% if you compute it. You go to a fine dine restaurant and you look at its menus 10 years back, and you would see 8-9% inflation, not those 5-5.5% which CPI gets published. So
tell me about it. We see that on a daily basis, right? In metros. But of course, gentlemen, it's been such a pleasure speaking with the two of you today. And the bottom line is, markets may fall, markets may rise, but SIPs, they should continue. And of course, keep speaking to your investment advisor as well. Thank you, gentlemen, again for joining us today and making sense of what investments should look like, especially during volatile times. So a sane voice like yours will help investors go through these times as well.